Okay, I want to thank everyone for joining another one of our amazing Leading Patriots series webinars. My name is Brett Josephson. I am an associate professor of marketing and the director of executive development within the School of Business at George Mason University. I'm just getting this kicked off today. I have a wonderful colleague who's going to be taking over the questions and leading the moderation section of the podcast of the webinar. So once again, want to thank you all for joining. We're going to kind of go through some quick introductions to the series, introductions to our panelists, and then get this thing going. So with this, I do want to provide just a really quick overview. Today's session is going to be moderated by Derek Horstmeyer. He is an associate professor within the School of Business in the finance department. He holds a couple different hats and titles within the School of Business. He's the co-founder and director of the Student Managed Investment Fund, and he's the director of our new up-and-coming financial planning and wealth management program. So encourage anyone who wants to get into these careers to contact Derek and find out more information about it. Really excited to be joined by our four amazing panelists today. What was, I wouldn't say difficult, but a little bit broad in topic at first when we were trying to figure out what to do in this sector is really going to be covered by the wealth of knowledge that is demonstrated by our panelists. People who span from kind of the CFO corporate side all the way to the personal wealth management side. And so we are going to be covering a broad scope of topics that deal with solvency issues, cash flow, the projections of where the markets are going, projections of where we think cash is going to be available for individuals and for organizations. So with that, as audience members, if you have questions, whether it's on the personal side, on the corporate side, please feel free to use the Q&A or the chat feature within Zoom. I'll be monitoring it as well as with Derek, and so we can get some questions thrown out to the panelists. Before we get going on the introduction to our amazing panelists, just a little bit about Exec Ed. So we provide or try to provide that bridge between from when you graduated till the end of your career, providing the capabilities, the competencies, the learning experiences that will help you reskill, upskill so you can be more competitive in your job market or with your organization. Reach out to us. We really try to be that connector back into George Mason, its talent, its expertise. We try to connect faculty with issues that you and your organizations are having. Also, this series was done in collaboration with the Alumni Association, and it would not have been possible without their support. This is something that we sat down with the president-elect of the Alumni Association, Sumit Srivastava, as well as the team within the Alumni Association, Jen Robinson and Michelle Murphy, really came up with an idea of highlighting either Mason alumni or friends of Mason in specific verticals or industry segments that we thought needed to have a voice right now, that were going through significant disruption, significant changes due to the pandemic, due to social issues. And we wanted to provide a platform and series for these individuals to talk about what they're going through, provide guidance and expertise for other Mason alumni, other friends of Mason who might be in those industries or who are curious about those topics. If you are not connected with the Alumni Association, I would suggest, encourage you to reach out to them, find ways to connect to their chapter. Three of our four panelists today are Mason alumni. They're connected with the Alumni Association, and you can get what is really one of the main benefits of these is the networking and the ability to expand your own professional networks and job opportunities. So reach out to them, join your local chapter, and see the benefits that it'll have for you. So with that, I want to, instead of me talking about the panelists, I want to have them give a chance to introduce themselves. And team, what I'm thinking is we say, a little bit of name, year you graduated, maybe your major, and then what was the class that you were most afraid of going into that class? What class made you the most nervous during your time at Mason? Or for Sharon, we won't, I know you're not a Mason grad, so you went to UVA. So what was the class that you were most scared of? So let's start with Ann. If you could give us a little bit, very quick bio about yourself, and then jump into a little nostalgia of your time at Mason.
Sure, that's a very easy question to answer. So, hello everyone. My name is Anne McCabe, and I run a firm called Curo Private Wealth. We are based in Reston, Virginia, and we do holistic financial planning and proactive investment management. And I graduated from Mason in '06 with a degree in economics and a minor in Latin American studies. And the class I was most fearful of that actually made me fall in love with econ was Rustisi. Not sure if he's still around, but he had quite the reputation but made me fall in love with economics. So I was very, very grateful that I was able to take his class.
Was that micro?
Yes, it was micro.
It was micro.
My first econ class. And at that point I was undecided in terms of what I wanted my major to be. So it was clear from there.
Jason, how about you?
Well, thank you. My name is Jason Howell. My firm name is a family wealth management firm. It's also called Jason Howell Company. And what makes us a little bit special is we leave our clients with at least 3 tools. Number 1, of course, the list of recommendations for their financial plan, which shows them what they need to do. Number 2 is an implementation guide, which tells them when they need to do it. And number 3 is something fairly unique to our firm amongst the country, which is a family governance tool, which really shows them as a family how to execute some of our different recommendations day to day. So there are many, many fewer arguments around money. So I majored in accounting at George Mason. I graduated in 1997. And the class that all accounting majors were afraid of was intermediate accounting. It was supposed to be the weed out class. And I can tell you that a lot of people got weeded out. In fact, all the good looking people went to marketing, and then everyone else went to MIS. And I stayed in accounting and just sort of suffered through it.
You know, we always say if you're not good enough to do accounting, if you're not good enough to do marketing, you go to accounting, right? It's never the other way around.
I guess so, yeah. Yeah, you suffer with the unattractive people who stayed in accounting. Yeah.
Great. Sharon, how about yourself?
Well, first, I should also tell you I was an accounting major at the University of Virginia, so I'll go along with that. I currently work at Hilton. I've been at Hilton for 11 years in various finance disciplines. And right now, as many of you know, the outbreak has certainly significantly negatively impacted the travel hospitality industry. I also got my MBA at the University of Chicago. And after I came out of MBA school, which was the summer of 2001, I went to work at American Airlines and was there, unfortunately, for 9/11. So saw all sorts of crisis there as well. So I was there for 6 years after MBA school. So I have been in either finance or accounting. I'm a former CPA. Cannot say I am now because I have not been keeping up on my continuing education. But former CPA, I did go to UVA undergrad. And I would just tell you, everybody that was an accounting major is beautiful. So that's just my opinion.
I'll take it.
All right. Bringing batting cleanup, I guess, as it is. Keith.
Good afternoon. Good afternoon, everyone. Thank you for allowing me to join today. Keith McKenna. I am a banking executive at BB&T, now Truist. Truist is the merger of SunTrust and BB&T that was finalized December 6th of 2019. We're currently the 6th largest financial institution in the United States. I am a relationship manager on our aerospace, defense, and government contracting team. I work with privately held corporations in the Mid-Atlantic area that are $500 million and below in revenues. My major was decision science, management information systems, and I had a minor in information technology. Probably the most difficult class I had was Visual Basics. It made me realize I did not want to be a programmer.
Right. I think we all have those classes that either decided which major we were going to be or which one we were not going to be, right? That it was one of the 2 areas. So thank you all for that. And with this, I do want to turn it over to Derek. Derek, as I transition slides and into the last one, why don't you give a little bit of bio about yourself that you want to add on from the beginning?
Sure. Thank you, Brett. My name is Derek Horstmeyer. I'm an associate professor of finance here at GMU. I've been at GMU just for about 7 years now, and started up the Student Managed Investment Fund, which has been doing really well for our finance students. And we're launching a financial financial planning and wealth management degree coming up in just about 3 months in September, where Jason Howell will be heading up the intro class to this. So we're very happy to have him on this Zoom meeting, and I'm happy to have everyone here. So with that, I guess, are we set to kind of launch right into the questions, Brett? Would that be good?
We are. Go ahead.
Okay, thank you. So first one, nothing gets clients or firms as nervous as changes in wealth or in cash flow positions. What were the first few weeks of the crisis like as you had to change your conversation with clients and teams? So I guess we'll kind of do this free form, but if anyone wants to jump in and say kind of how the crisis really changed conversations with clients or teams, please let me know if you want to lead it off. Sure, Jason.
Yeah, for us, with our clients, we just thought the best thing we could do was to be overly communicative. And I think we got the same reaction from our clients that we usually do, which is a lot of nothing, pretty much. So we started, writing letters to clients. You can go to jasonhowell.com and you'll see we posted them in our blog. And these letters to clients were kind of coming out every 2 days because it just seemed like more and more action was happening, especially, of course, with the stock market. And so we would send these to clients and wouldn't hear much. In fact, I finally heard from two of our clients, and they were just looking maybe to get in a little bit more. Then I heard from siblings who were saying they wanted to buy into the market, which I said, you don't have any money, so don't even pretend to play with us. But it was really an opportunity that I saw to communicate more, at least to clients. And if they needed to raise their hand, then they knew they could come to me and our firm because we were paying attention.
Yeah, I'll piggyback off. Oh, sorry, Keith. I'll
No.
piggyback off what Jason was talking about from the private wealth side, and then we'll go over to the corporate side. So I think definitely communication has been huge. The other thing that I think is really important running a wealth management firm where our revenue is tied to the markets is to be really prudent and conservative at all times, not just when the market drops by over 30%. But one of the things that I have been really religious about since I've owned my own business is when I'm looking to make investments in my company or to hire, I whack 30% off my revenue numbers, just because that can happen at any time. And so going into this crisis, thankfully, we weren't in a position where we had to let anyone go or make massive changes to our expense structure because we weren't at a point where we were spending, every bit of revenue that we were bringing in. And to that point with clients, I think it's really important to just let them know that what we saw in terms of performance in 2019 was fantastic, right? None of us were complaining about how much money we were all making in the markets, but I'm sure Jason did the same thing, just kind of communicating with clients and reiterating that this is not normal and you should not expect this type of returns again in 2020. Of course, we didn't know that COVID was going to happen, but all of us can pretty much agree that we were overdue for some sort of pullback. So that part was normal. And to Jason's point, most of our clients were pretty calm, and as long as we were communicating what was going on and what they should do about it, they've been okay and they've stayed the course, which is the most important thing in a situation like this.
Perfect. And I'll chime in as well. If you think about from a banking perspective, banking has become sort of a commodity, I would say. And during the COVID-19, a lot of my clients were looking for trusted advisors, somebody that they could speak to about their cash flow needs, what am I seeing and hearing from other clients in my portfolio. And to everybody's point on this call, communication was definitely key. I had clients that would call me daily just to see where their cash position was, where's the bank stance when it comes to PPPs. And this was all something that I feel was very valuable, not only to my clients, but just to the market. Because definitely access to capital was definitely something that was of concern to a lot of my clients and then to business owners in general.
Very, very interesting stuff. One quick follow-up there. Did you find any strategies, again, since we have a number of people here that own and run their own businesses, did you find any strategies coming into this crisis that really paid off, like holding a large cash buffer or something else kind of along those lines?
100%. liquidity is key, especially in the down economy with uncertainty. So I had clients that would advance on their line of credit. They wanted to have access to that capital sitting in their depository account, as opposed to the possibilities of banks' capital drying up and cutting back on lines of credit. So there was kind of that assertion to make sure that liquidity was available if needed for payroll or other expenditures to keep the business afloat during these uncertain times.
And I'll also say, Derek, having your technology in place and being a little bit forward ahead from what you think you might need today is important. Our firm was fortunate in part because I was on other boards that were across the country. I already had Zoom. I already had a camera. I heard there was a run on cameras on Amazon, so you had to buy a new laptop to get a camera if you didn't already have one. And it was kind of lucky that I already had those opportunities. And so this has been an accelerator. That's what a lot of people have started to say about COVID-19 and this crisis we're facing. These things were going to happen at some point. As Ann said, the market was going to take a tumble at some point. It had been 11 years. So at some point, but this just pushed it so much faster. And when it comes to business, you kind of know you should have a buffer, hat tip to Ann. You kind of know you should have some cash, hat tip to Keith. And then there's this idea about, we all know we should be advancing our technology and our systems and our models and just always pushing that envelope for the benefit of our clients.
I can also then wrap that piece up by saying, yes, we were one of the clients of banks to pull our lines of credit over at Hilton. So it's just like your personal bank account. You have, cash is king. Everybody hears that in their finance class. It is probably something I've said more to than anything I've ever said in my life to people that work for me. So you don't worry about your P&L right now. You worry about, your bank account and what your daily cash burn is. I read today, again, having come from the airline industry, I still read news on it. United is burning $40 million a day. Just let that simmer for a second.
Yeah.
And, therefore cash is king. United Airlines will probably come out of this one way or another. But that is what companies are facing depending on what they have in terms of their promises and their obligations. So just you take every dollar that you can as soon as you can take it, and then worry about, the interest that you're paying later, pay it back as soon as you can when you're back to being healthy.
Very interesting. Very good answers. Thanks for that. To kind of follow up on that, so looking forward, have you guys, again, this is kind of a question geared toward people that are running their own business or their own lines of business. Have you adapted or changed kind of how you're running things, looking forward?
Well,
go ahead.
I was talking about having the technology in place. We also got incredibly lucky. No, we can predict the future. We sent a letter to our clients at the end of the year. And in that letter, we said we wanted to increase our touch with the clients and add more value. And we wanted to focus on that. Inherent in that was that we were going to do more virtual meetings. And so in that regard, we were already sort of prepping for virtual meetings and hoping that our clients were going to be mostly okay with it, some of which we're already doing virtual meetings. So in that sense, now we've felt like we can fully commit to that idea of having virtual meetings. That's been a change, whereas we thought we might be sort of dribbling into it over the course of 2020 and maybe into 2021. Now we're going to be that firm that can say we meet virtually. If we want to see each other, we'll have lunch, we'll have dinner, we'll take you out just to hang out. But this is now an opportunity to say, let's get the work done quickly and efficiently, in a sense, over Zoom.
I was going to say what has changed at Hilton is certainly kind of referencing back to what I just said. We have obviously, like every company, a laser focus on the P&L, expenses and revenues. But with accounting rules and accruals, it doesn't exactly always tie up to cash flow. And I knew I am responsible for forecasting and budgeting and those things. And I knew going into our earnings release in May that they care, but they don't care about the P&L right now. And it's not something that anybody was going to ask about on an earnings call. So, we put the proper effort into it. But at the same time, we said, there isn't going to be a whole lot to talk about because the numbers are going to be meaningless with impairment charges and all sorts of other special items. So that really did, whereas we were a highly P&L focused company who always cared about cash flow, but never had any cash constraints. Now is everybody's going to ask about cash, and we just need to be foot forward there. And if you are properly prepared, then the market will reward you for that.
Yeah, and I guess this to chime in as well. Kind of our mantra going to the year after the merger with SunTrust was T3, touch, technology, and trust. And if you think during this whole pandemic, those are three things that we have been afforded the opportunity to double down on by making investments in technologies, kind of looking at the way that we do business with our clients through different means than your face-to-face interaction. Obviously becoming a trusted advisor to our clients during these uncertain times, and really driving the touch piece. To Jason's point, using WebEx to have meetings with our clients, but also having the video enabling feature to have that visual sight as you're talking to your prospective client as well. Those are all key things moving forward. They're going to be ingrained in our business lives as the new normal as well.
Yeah, I definitely agree from a business standpoint. I think more of us will be conducting more meetings virtually. I think there's a really fascinating conversation around commercial real estate and what that's going to look like in the future. I've heard just anecdotally so many business owners mention when their leases are coming up for renewal, they're just not going to sign for as much space as they have now. So that will be something to definitely to watch in the near future. And I think from a personal finance standpoint, I know Jason and I spend a lot of time really talking about the not so sexy stuff in personal finance, which is don't spend more money than you make, and make sure you have a nice solid, cash position. To Sharon's point of cash is king, and it is, and it always will be. And when times are good and you're making 30% returns in your portfolio, it's like, yeah, cash, that stuff. Okay, whatever. And yeah, I know I'm not supposed to spend too much money, but hey, it's coming in, and, income's not a problem. And it's times like these that we really have to go back to the basics. And now that cash reserve thing is looking pretty sexy all of a sudden. So my hope is that we remember these lessons during crises, and we take some of those lessons into when times will be good again. And we get to conscious spending and really making sure that, I'm not saying don't spend money, right? That's not at all my message, but just being very aware and conscious of spending money that is adding value to your life and in line with your values, and creating great experiences for yourself and your families versus just spending money because. So that's my hope from a personal finance standpoint in terms of a change. We'll see if it happens.
Yeah, I mean, to Ann's point, there's a whole science around neuromarketing, right? So there are literally scientists that work with marketers to get you to spend when you're unconscious, when you're to your subconscious, the part of your brain that you don't acknowledge, but that makes you want to do things and it makes decisions. That's not good for the consumer. It's great for corporations, but not great for the consumer. So that ability, as Ann Day was saying, to really force yourself to be more aware, that's going to do so much for, all right, the P&L side of your, financial statements, but then of course also for that balance sheet side, how much cash you end up having in reserve and how much debt you end up incurring or not incurring. And so that mental ability is actually really the bigger piece of your overall financial planning. Can you control what's happening, even though when there are characters out there, professionals, scientists, that their whole income is based on you spending a little bit more than you might have done consciously.
Sorry, go ahead, Keith.
No, I was going to say, Ann actually brought up a good point regarding the commercial real estate and just clients maybe looking to downsize their lease space, especially as we roll back into the office. And it's going to be very interesting to see, especially as cases continue to spike in some states that are open for a couple of weeks now, on how organizations are going to utilize their space. Are they going to be looking to get additional space just to make sure that they have the social distancing between their employees, or are they going to allow employees to kind of work more remotely from home and kind of continue the kind of same dialogue efforts we have seen over the last couple of months?
But we like our Hilton spaces though. Like I'm hoping for a vacation in August, Hilton timeshare.
Oh yeah.
We love that space.
We will support you.
We're open for business, so
Excellent.
Come on by.
Stay in South Carolina open.
Yeah, the great points, all Ann and Keith. Yeah, that's a really interesting debate that's going on. Just the other day, I saw two people that manage, REITs on CNBC, and they were having a really strong back and forth about what is going to be the effect on commercial real estate. Is it going to cause it to all collapse in and everyone's just going to work from home? Or because we're going to need to now socially distance everyone, now do you need twice the office space? So yeah, really, I don't know the answer, but it would be curious to see what side of that argument wins out.
Yeah.
Yeah. So yeah, I think we'll see that in the next probably 6 months or a year, see, which direction people go. But yeah. To kind of continue on kind of, what's happening currently, what are you telling your clients and teams as we start to see the economy reopen and things kind of start picking up? Are you moving business back into the office place? Are you repositioning clients or telling them to think differently about their money? Or how are kind of things changing now that, at least in the DC area, we're starting to see things come down a little bit?
I'll kick off. We've been mostly working remotely. I am currently in my office in Reston right now. So I've been coming in a couple days a week, 1 to 2 days a week. We still do get some physical checks in the office and things like that. So we've had to continue to come in, here and there. But I see our company operating a lot more virtually, especially as Jason mentioned, as clients are getting more and more comfortable seeing us virtually. I just don't think it's worth the risk if we can do business pretty normally. From a portfolio standpoint, back in March, April timeframe, we were looking at pieces of the market that had been that had declined substantially, and there were lots of areas of the market to look at. But we did add some positions to the portfolio that we thought would be good performers during the crisis, as well as on the other side of that. So we have made a few changes to portfolios, but for the most part, our message is, stay the course, and hopefully you had a good allocation coming into the downturn and you knew how much risk you were taking on in your portfolio. And while the reason behind the decline was a surprise to most of us, the actual decline should not have been. We see the S&P sell off more than 30% roughly once a decade. We had been, 11 years without really a large sell-off. So that from that standpoint, it was pretty expected. So our message is just really, to stay the course and not get emotional and sell when everything goes down.
Yeah, Peter, for us, I mean, we really have a sort of a core and satellite approach, which means for the majority of our clients' monies, we're pretty much going through something that's passive, that's broad market. And really the client is the one that drives some of the satellite. For the most part, we're working on the core part for our clients. And unless they have some sort of special stock, some special interest in bonds, we're going to put their entire portfolio in that sort of core broad market approach and ride this thing, ride the wave. We were heartened really late March and into April to see the market kind of bounce back. And it really underscored that reality that we couldn't take all of our clients' monies out just because the market was tanking. If we had done that, we would have not have known to go back in, early April and watch it pop back up. Just as much as we wouldn't have known, what was it, last week, to see the market drop 1,500 points, at least the Dow. You can't know that. And so taking that long-term approach for our clients has been really easy to do. Now, whether it's Ann or myself or other comprehensive financial advisors, typically we're working with investors, not traders. And that's the big difference. If someone's hiring an advisor to trade, that's not really going to be me, probably not going to be Ann. But if they're saying we want to invest and we want to have a retirement and do some other things with our money in the long term, then that's what we kind of do very, very well. And so when you see these fluctuations in the market, that is just part of what happens. It's part of what makes the stock market something to invest in. That risk gives us that risk premium, which allows us to have gains that are over and above what we can get at a bank just sort of sitting in cash, at least for the money that's not in cash. So we love cash, right, Keith? Keith is it's amazing. So we'll take both.
Yeah, and I guess from a banking perspective, being very proactive is key right now. With every conversation I have, I start the dialogue around the COVID-19 and just the effect on their business, not only to show empathy to what they're going through as a business owner, but also to show them that I'm here to help as a value-added partner. Truist is a very strong institution. We have a very strong balance sheet. So we're open for business, as I always tell clients. So there are still a number of clients looking for capital to finance acquisitions, plant equipment, things of that nature. While it has slowed down tremendously because a lot of clients are sitting on the sidelines, kind of a wait and see approach. So hopefully here in the next quarter or two, we'll start to see things kind of get back moving depending on if the second wave comes to fruition or not here in late fall, early winter time.
I can actually take it from the HR side then, which is not people's investments, but people's paychecks and their jobs and their prospects to keep their jobs. If you're, to your point, Ann, an 11-year expansion, if you're 32 or 33 and younger, you've never seen this. And, Hilton announced a couple months ago, we have furloughed many, many, many people globally. Marriott did the same thing, and Marriott announced a few weeks ago that they are going to continue furloughs and there will be jobs lost. You can make whatever assumptions you want about whether Hilton or others will end up in the same position. When I had to furlough a lot of my US team, I had, it was a one-person speech because you're not going to do that over video. And of course I had, as encouraging a words as I could, a lot of empathy. There were also pay cuts for people who remained behind. But whether it was going to be heard the right way or not, I felt it was incumbent on me to tell people that if you're young and you have not seen this yet, it will happen again in your career. And you have to be prepared for these economic cycles. Some are more, I guess, worse than others. Some will hit industries in different ways, but it's going to happen again. It's not going to look the same. It's going to happen multiple times if you're working for the next 40 years. So, we've been able to be really spoiled over the last 10 to 11 years, but just don't forget this as you do move forward in your career. And even if it's not with Hilton, and just make sure you're as prepared as you can be to weather the storm, because sometimes it just isn't your fault. And sometimes it's just, bad luck. So that was something that I passed along. I was like, boy, I hope that's taken the right way. And interestingly, someone that works with me has mentioned that multiple people have brought that up to him as something that they were happy that I said. So I was like, well, thank goodness they got that the right way. But I had to say it because a lot of folks don't realize that this is not going to be a one-time deal in their career.
Yeah. No, that's kind of, I don't know what the phrase is. It's not tough love, but you have to have that discussion with somebody, and present reality that this is going to happen again in the future. To kind of follow up on that, I know Jason, Ann, and Keith, a lot of your clients are not in the hardest hit demographics here. We've seen a lot of people in their 20s and 30s in the retail space and in the restaurant space get furloughed and fired, but maybe some of your clients' children are in this kind of space. Have you had to have any conversations, kind of, with clients about what's going on with their family and their extended family in these kind of tough times? And
yeah, I actually had a real live situation this past weekend where I took my car to be serviced. So the dealership I go to service my vehicle is normally pretty well staffed, and a number of employees I've gotten to know the last year and a half or so. So in checking in my vehicle, I asked a question. I don't see a lot of the faces that I used to see. I thought you all were an essential business to staying open. And the individual I was speaking to did let me know that they reduced their staff by 40%. However, corporation has decided to not bring those employees back because they're now back to 90% of revenues with the reduced staff. So they find themselves being more efficient and asking themselves, do they need to staff back up to the numbers that they were at prior? And I think that optimism that is in the air as far as the individuals that are furloughed and potentially going to be brought back to work once the pandemic has passed, I think that's optimism is going to slowly go away as individuals quickly realize that they're not going to have a job to go back to in a couple of months from now.
Yeah.
Because our firm works with families for the most part, and we really focus on the entire family, we have one set of adult children for one of our clients. One of them works on Broadway and has been working as an actor in New York for a while now. And, we've just got a Broadway gig, and thankfully it just closed right before this sort of happened. What's interesting about people who work on Broadway or in New York and actors, they're used to filing for unemployment and getting that kind of done. It's sort of a normal process. Your show starts, you make money, then your show ends, and then you file for unemployment. It's just part of the deal. So the timing worked out exactly right for his performance. Whereas one of the other adult children was a doctor, and working in emergency rooms. And so she was very, very busy. Might have liked to be furloughed for 2 weeks or so, but that just wasn't the case. And so with each of our clients, we see so many different pieces and so many different angles of this, but sometimes all in one family, which makes it kind of, something that you have to do beyond just the numbers. You have to have conversations that are in and around psychology and the like. I'll just say one more point. At the beginning of this, I was much more positive about essentially where the markets would be headed, because it was sort of an intentional drawdown of the economy. And you just sort of sit back and say, well, all right, if a year from today we have a vaccine, how much better is everything at that point? For this immediate crisis, I think it's a lot better. I just read an article, though, this weekend in The Atlantic. You could maybe pull this up, though, about collateralized loan obligations and how that's a lot like collateralized debt obligations of the 2008 crisis, and how much of that is on the books of so many mid-sized businesses. And if those kind of go bust because people don't get to work and people don't spend over the next 6 months, what that could do for not just those companies, but also our big banks. I didn't see anything about Truist in that article, Keith, but I saw some good stuff about Wells Fargo and some of the other large players. And so it's a very interesting time as we see these things connect. I've even learned over the past couple of months what the Fed could do. I didn't know what the Federal Reserve was really capable of in some ways, to see the actions that they've taken. And so whether those actions, adding about $6 trillion to the economy or to availability, make a huge difference to even CLOs or not, is an experiment that I think many of us are going to see for the first time.
Mm-hmm.
Yeah,
Yes.
I don't think the Fed quite knew what they could do either until they were.
Yeah, maybe not. Maybe not.
Let's see what we can do here.
Right.
Powell just keeps coming up with new ways to get money into the banking sector and into the economy. I got to give him credit. He's pulling on every lever he has. So
yeah, and don't fight the Fed was a big thing during the financial crisis, and it's a big thing right now. So yeah.
And on that Atlantic article, I read that same one. That was a little bit disconcerting. I think it was by, if I'm remembering correctly, it was a guy named Portnoy, a professor at Cal Berkeley.
Okay.
So if people search, I'm sure if they search those terms, they'll find that article. And it was, a little bit disconcerting about the level of CLO in particular banks. Yeah. Thank you for that. I wanted to get one CFO type question in here, because Sharon has kind of worked in that space, and so I'll throw that. This is a question kind of directed right at Sharon. With your experience at Hilton and American Airlines managing and dealing with capital structure issues, how do you think this market volatility has affected kind of CFO's financial decision making, and has it at all affected your current operations with Hilton, or how you're thinking about things at Hilton?
Mm-hmm. I mean, ultimately, the market volatility doesn't impact the actual company, right? It impacts the investors of that company. So certainly things that Hilton would do that impact investors specifically are dividends and share buybacks. And that's not happening, obviously, because everybody is now pulling back. Well, I guess some companies are still doing that. I do read that. I'm a little surprised, but all the hospitality companies, I believe, have said that they're largely ending that for now. Dividends and share buybacks are the best way to get money back to investors at the end of the day. But you only do that if that is the highest return for that investor. So right now, there are times when you have great projects, you invest in them in the company, and the rest you give back to your shareholders. Right now, the smartest thing to do is to hold on to that money and weather the storm, so that we can make sure that we, using the little R restructure correctly, similar to what Keith was saying. I mean, everybody's going to go back and look at their expense structures and make sure they're as efficient as possible before you go back to your financial strategy and what you do for your shareholders. So certainly at Hilton, the immediate answer to that is we stop dividends and share buybacks for now. And I'm sure it won't be permanent while we weather the storm. When I was at American, they were not, airlines are rarely in the position to be able to do that. I know they were doing that of late. They're much more volatile and much more difficult to predict. So you have to be a little bit smarter about your cash. And certainly, they also are, I'm sure, based on my experience after 9/11, hoarding every dollar they can get, but they're certainly closer to the brink. They have much bigger operations with many, many more obligations like labor unions, pensions and wages and all that other good stuff. So Hilton, thankfully, is a different type of operating company and doesn't carry that much in terms of obligations. And so we will be able to restructure with a little R. Again, I don't think we need a big R restructure, and come out on the other side and then get back to our philosophy in terms of returning or returns for our shareholders.
Interesting. I'll kind of open it up to the group because you touched on issues about dividends and so I was thinking, for those that manage money, what have you tilted clients' portfolios to either dividend? Well, how do I say this? We've seen a lot of winners and losers. We've seen big moves in, Amazon and Zoom going way up, and then other companies going way down. Has there been any strategies with respect to tilting toward dividend players or taking advantage of particular tax situations like tax loss harvesting that you've kind of done in the last few months for your clients?
Yeah, I'll start with
Go ahead, Ann.
that. We have definitely had lots of opportunities to do tax loss harvesting this year. So that's a benefit when you see the market decline as much as it has. And in terms of our positioning right now, we're much more neutral. I think that's a call that is really hard to make. You can look at how growth companies have outperformed value companies now for a solid lot of years. And you could see that and say, okay, the trend is going to flip the other direction and value companies are going to outperform. But I've quite frankly heard analysts say that for a number of years and it hasn't played out yet. So instead of trying to make that prediction, which I think is a little bit of a crystal ball prediction, I'd rather just have exposure to both sides, to value as well as growth, and give clients exposure to that. In situations where we have to generate income for clients, we'll definitely tend to try to find higher dividend paying stocks and income producing securities, but for the most part we're pretty neutral across that board.
And traditionally, we take a value approach to our investing, but broad market still. And so when the decline happened, the most important thing for us to do is to take the right moment for a rebalance, so that our clients could take advantage of being in the right categories at the right time, as we had in their investment policy statement. And there are only a couple of clients where we made some adjustments. Some older clients that maybe could have used a little bit more cash in their portfolio. And they should have been tweaked maybe a little differently before, about one or two. And then there was a client who had gotten out of a position that he kind of liked to essentially go broad market. And that particular position had tanked unnecessarily, and he bought a bunch of it. And I can say up to this point, he's made about 30% on that particular call. Not our call, but we knew he was interested in it. So that's an example of that. If you want to do a little satellite as our client, we will sort of keep that open for them. But it's not what we do best. We're not stock pickers. I mean, I couldn't have predicted DocuSign would be at 200% gain right now. Nor could I have predicted Zoom when about 5 or 6 months ago, people were saying Zoom was overpriced. Maybe it was for then, but now it could be priced maybe double what it is today. And so it's kind of fun, having that sense around what is our actual investment philosophy as a firm, communicating that to our clients and being able to hold steady to it. It's been nice to see that play out through this kind of a market and still feel like we're surviving and our clients are doing well.
Very nice. So I want to leave for about 10 minutes of questions. So I'll ask one more kind of question that questions from the audience. So I'll ask one more question that I had in particular. So we've kind of seen, it's become more and more apparent that this second wave of coronavirus is going to take hold in the next, in July and August and maybe into September in certain regions of the country. How does that affect your fear level? And how does that affect you think the fear level of some of your clients, and what do you think you might do to mitigate that?
Derek, yes, so there's continued conversation about the second wave, and my personal fear level, I do travel quite often for work. So I'm in no hurry to jump back on the plane. Having a daughter that's asthmatic, so definitely no hurry for that. But a lot of my clients are kind of taking the wait and see approach. A lot of my clients did think they would be kind of bringing employees back into the office in the June timeframe. Now most of my clients are telling me August. Then you have, think about from the educational standpoint, are schools going to reopen in the fall? Or are they going to continue to be on an e-learning schedule for the first part of the 2021 school year as well? So it's all interesting, but my sense of awareness to the situation is still very high.
Yeah, I mean, for me, it's a very personal sort of fears that mirror the clients that I work with. I have young, tiny humans, and so there's no camp this summer. So how are we going to keep one of our daughters busy? And one of our other daughters is going to start going back to daycare on July 1st. You know, so is that really safe? I think it is. But we still have to work. Both my wife and I have to work. We know our clients face those same challenges. And then I think today, in fact, right now, concurrent with this call, Fairfax County Schools is revealing what's going to happen this fall. And then this evening, they're going to talk about reaction in a town hall to whatever it is, whether it's going to be mixed schedule, whether it's going to be all virtual. That's a call that's going to be, I guess, about 8 p.m. tonight for Fairfax County Schools. But of course, you know, most directly, what I'm concerned about is my Hilton Worldwide opportunity this August to go on vacation. I don't know if I'll be for the third year in a row missing South Carolina those past 2 years because of hurricanes, and then this year because of COVID. I might just say forget vacations from now on in. But you know, these are the practical conversations that, you know, I think we're all having, and that we're certainly having with clients that care. As far as the markets go, long-term approach. Investors, not traders. There's not much that we can predict, and not much that we can do in anticipation of what we think might happen. Not even the epidemiologists know exactly what's going to happen. And some say this is still the first wave of COVID. It's just we're tired of it. So for us, it's like it's over, it's the second. But we really haven't gone through the first wave, and it'll be very interesting to see what happens between now and the fall and January, when hopefully there's a vaccine.
Thank you. I'm going to jump right. We have some interesting questions here in the Q&A. So I'm going to ask. This one is directed to Keith, but then I guess we'll open it up after Keith gives an answer. I guess anybody can jump in and answer this one. Keith, from a lending perspective, what type of adjustments are you seeing in the debt markets? What are you guys now looking for from your investors to mitigate risk? And are you guys interested in a certain type of assets over others? This is from Whitney.
Hey, Whitney. From an underwriting perspective, banks have certainly tightened the criteria at which they are looking at. I think first is to understand the client's business and how they are affected by the COVID-19 pandemic, and what's the long-term effects to their cash flow. If it's something that's short-term in nature and that's going to rebound fairly quickly, then it's business as usual. But to your point, we are looking at the strength of clients' balance sheets. How much liquidity do they have on hand? Are they over-levered? Those are kind of the normal things that you look at when making a transaction, but it's heightened during the pandemic as well. But there, as I mentioned earlier in my conversation, Truist is a strong institution, strong balance sheet, and we're open for business to lend money to corporations that need it.
If there's any, well, I'll jump to the next one. This one is kind of on career track issue. Dudley wants to know, does anyone on the panel have an opinion about the advantages of an MS in finance versus MBA for somebody in their 50s who is looking to make themselves more valuable to a current employer?
That's you, Shaq.
I was going to say I can opine a little bit. I mean, here's the thing. I've had this conversation with 100 people that have come through my office. A lot of people go to hospitality school, and then they come to a place like Hilton and then decide, do I want to stay in hospitality? And if I don't, should I get my MBA? And all those questions. So first of all, I mean, I can't speak to your specific situation, Dudley. But what I will say is an MBA is extremely broad. So if you are looking for the broad education, and I mean not just what you learn in the classroom, it is learning how to be a leader and spending time, doing those things versus actually taking a class on it. And all of the communication and other things that you aren't going to necessarily learn in a classroom for many MBA programs. Not having gotten an MS in finance, I got an MS in accounting. My MS in accounting, it was very specific and technical. And so my view is the MS in finance would probably also be specific and technical. So again, not knowing your situation, what I would say therefore broadly is an MBA is much more of a holistic business experience. And although there are technical pieces, and depending on where you go, you can make it as technical as you want. The MS in finance is going to be much more technical. My guess is probably cheaper too, but I think again, that depends. So to me, that's at a high level what I would look at between those two options.
Very good. Deb, who was a former student of mine, just wrote in the chat that she's an MBA she got her MBA. Oh, she's waving to me. Hi, Deb. Got her MBA at GMU at age 55 and doubled her income. So, there you go.
Impressive.
Yeah. We have another question from Whitney. And this again is kind of on capital. And I think this might be the last formal question, and then we'll open it up for any concluding remarks. Whitney again asks, there's obviously been an impact on capital for some businesses and investors, but the reality is there's a lot of capital out there looking to invest their dollars. Where are you guys seeing the majority of your clients want to move their capital to, and where would you suggest moving capital to in the current market?
I'll just say my clients haven't asked me to do anything alternative than what we are doing. However, there are some savvy clients who may consider alternatives, right? I don't think this is a great opportunity for real estate alternatives because you better know what you're doing with that, considering the tea leaves that we're all reading. But there are opportunities really just to, and I would put this in my final comments as well, make sure the hierarchy of your plan is in place, that your debt is reduced, if not gone, and your savings are there for emergencies through the end of the year. And then you're looking at the broad markets, and then only then would you get kind of crafty with your investments.
Very nice. With that, I guess, Brett, do you think final comments would be nice? If there's anybody that wants to kind of give one little bit of advice to those who are listening out there, please jump in. Anne, if we could start with you.
Yeah, sure. I think this year is a very important reminder on a couple of things. One of the things that Sharon shared with her employees prior to having to furlough them, I think is actually great leadership. I don't even think it's tough love. I think it's because it's true. And if you look back, certainly on my career since I've been working, we've had the financial crisis, we've had 9/11. Prior to that, we had the stock market crash of 1987. There are things that will happen time and time again in the economy that we don't know. We don't know what they're going to be. We can't predict them. And they're of no fault of any of us, right? They're totally out of our control, but that's why it's so important to Jason's point, have a solid plan, make sure you have nice cash reserves in place, don't spend more money than you make sure your retirement is set up, et cetera. But this year has also been a really important reminder that no matter how smart you are when it comes to investing, no matter the resources that you have access to, none of us know what is going to happen in the stock market. And I know that really hurts some of your feelings, and it may burst some of your bubbles that, would like to be able to predict what's going to happen. But you have Bank of America who just got it all wrong. They missed out on, the most recent rally. You have Mohammed Al-Arian, who's one of the brightest people in our industry, right, who got it all wrong. So this is not to diss any of them or to insult them. It's simply to say that we don't know. And so it's really important to have a solid plan, get your foundation in, build out a good diversified portfolio that can weather all storms, and then just let it go. So those are my final remarks.
I couldn't agree more on that one. I've learned that one the hard way many a times. I was saying to Jason earlier, this was about a few weeks ago, I thought or maybe a month or two ago. I thought Tesla was overvalued at like $300. Now they're up to 900. Lost a lot of money. Every time you think you think something is irrational, doesn't make any sense, it can still go up, another 100%. So.
Right. Just remember though, people who jump off a 40-foot, 40-story building think they're flying for the first 39 floors, right? So we don't know how that story is going to end.
Yeah.
Derek, did you do a short after you told me not to do shorts?
I did. I will own up to it that I did indeed short Tesla.
Wow.
And I got burned pretty bad on that one. And my students made fun of me mercilessly because they kept saying, they're all 21, 22, and they're saying, never bet against Elon. It's going to go up to $2,000 a share. It's just going to go. And, you don't bet against Elon Musk. I guess that was the lesson I learned.
There was a kind of a last question that I'll just jump in and do it. And I think even Sharon, it is interesting, even from your side, from the corporate side on some of these things as well. But Zita, probably butchered your pronunciation, sorry. What asset classes do you prefer in light of potential market volatility, especially, among fixed income, equity, derivatives, or options? So I think, that definitely can go, and Jason and Keith, but I think even Sharon, like the corporate side.
No.
Well, and how Hilton's going to be shifting its resources around, those are going to be really interesting questions.
Yeah, Sharon went to the Chicago Booth School. That's a big deal. I think he's going to give the answer.
I only took one investments class. That's not my forte. I'll rely on you guys.
They only have a wall of like 50 economists who have won a Nobel Prize.
Here's the thing. I'm still working and I'm not retired. So that should tell you everything.
More.
Listening to you guys. Need to get my retirement going here.
And you want to take that?
Yeah, sure. So I'm sorry. The question was what asset classes, equities, derivatives. Yeah. Okay. So we don't do anything. We have not shorted Tesla, thankfully. Sorry, Derek. I can feel you though, because I've made plenty of other bad investments that I've lost lots of money on. So, that's the only way to learn sometimes.
We all have.
Hit you where it hurts in the pocketbook. But we're a pretty plain vanilla shop ourselves. So we deal mostly with exchange traded funds, some individual stocks, mutual funds, that kind of thing. We don't do anything with derivatives. We don't do any options trading. We don't do any day trading. So that's definitely, so I would stick with equities. We do traditional, fixed income for the bond side. And we do some in alternatives, but all liquid alternatives. So we keep it pretty simple.
Yeah, I'd say to the person asking the question, a wonderful thing for you to choose for yourself is an investment philosophy of some sort. Are you a value investor? Are you a growth investor? Are you an active investor? Or are you a passive investor? Do you look at the entire globe of investments where it's 50% US and 50% the rest of the world and think that you should pretty much split that evenly? Or do you think you should have some sort of home bias, right? Where most of your stuff is in the United States. And there are a lot of financial advisors who do that. And maybe they have good reason because we have our own, federal bank. So it just depends on those thoughts first, and then you can mess around with it. And that takes just taking some time and learning about the different philosophies, and then you'll be fine to pick your own and sort of stay in that direction. Don't veer off too much, otherwise you will make some mistakes that will burn you in the pocket.
Yeah, and be careful of what your friends tell you they're doing in terms of trading, because no one will ever tell you. I mean, bless you, Derek, for sharing your Tesla story with us, because I can't tell you how many times clients have come in. Well, my neighbor, bought XYZ stock, and I'm like, oh gosh, here we go. But they'll never tell you when they lose their shirt. So just to Jason's point, once you come up with a philosophy, stick to it, tweak it as you learn, and as you learn what's working and what's not. But just be really careful to not listen to your neighbors. Do not get financial advice from your neighbors unless they're qualified, obviously.
All right. That is great. We're at the top of the hour. I do want to thank the panelists for such amazing content. I know we covered a broad range of topics given the diversity in terms of thought leadership that we have on the panel. So I just want to thank you all for that. Derek, thank you as always for joining this. Derek, Jason, and I did a webinar 2 months ago on kind of the financial and smart investing. For those of you, it's available on the Mason Executive Development YouTube page. go check it out. I think a lot of the concepts, still be relevant. There is some continued discussion around, bringing back this series, especially around, the financial and wealth management side for the alumni, bringing in people like Jason, like Ann to provide those. So for the audience, if those are continued things that you want to see, shoot us an email, let us know, and we'll try to provide that content. Do want to end at least saying we have a series of these Leading Patriots webinars coming up. So we have on the educational market, so we're going to be looking at the K through 12 industry and what that is going to go through. We also have one coming up about HR and the issues around human resources and talent development, and then we are ending it up with some entrepreneurship and new investing. Not new investing. Geez, now I've got Jason. I've got your stuff on the brain. New ventures models. So I'm really looking for that one of, how do you start a new company in a COVID-19 pandemic, and how do you even go to investors and try to get some angel capital? So really looking forward to this once again, and I'll end it here with just saying thank you all for joining. Thank you to the panelists. Thank you to the audience, and we will see you. The next series will happen on June 22nd. So we will look forward to everyone next week.